All set.
Okay. All right. So what we're going to talk about is, so you better understand insurance. I want to make sure you understand how insurance companies work. Okay. So there's two universal principles that insurance companies must adhere to in order to make the insurance work. One of those is called the law of large numbers. Okay. And all that means is, Cameron, how old are you today?
23.
23. So they know that they got 1,000 23-year-old males. They know almost to a great degree of confidence that how many of you might die this year. And then when you're 24, that number gets just a little bit bigger. And now in that same group is out here and you're 45, that number gets a little bit bigger, right? So it's just the law of large numbers, right? The second thing is the insurance company has to be able to make a little bit of money. Would you want your loved one's protection with an insurance company that isn't financially solvent?
No.
Absolutely not. And so they have to be able to pay guys like me, pay for these nice buildings that we all operate in, and most importantly, they got to be able to provide the death benefit to your loved ones in the event of a premature death. Agreed? All right. So that's the two universal principles. So what happens is the client comes to me and says, hey, Jim, I want to make sure I take care of my loved one. I want a guaranteed death benefit. Okay? Now, if they're going to give you a guaranteed death benefit, Cameron, and as you get older and older and older, and based on these two universal principles, what has to happen to that premium every year for them to give you a guaranteed, if they're going to give you that guaranteed death benefit, what has to happen to that premium every year as you get older and older because of these two universal principles? It has to increase. That's exactly right. It'll look something like this, or maybe like this. Okay, so there's all kinds of different ways that it can be designed. But this is what they call in the industry a level term. Okay, where the death benefit is guaranteed for a period of time, but the premium must go up because they're giving you something that's guaranteed. So in order to adhere to these two universal principles, that's what has to happen. So most of my clients say, well, shoot, that gets cost prohibitive over time, and it does. And they say, well, that's not good enough, Jim. So I say, all right, how about we do this then? Let's give you a policy where the premium is now locked. It's guaranteed. Okay? But Ron, again, adhering to these two universal principles, if they're going to charge you the same premium every year as you get older and older, what has to happen then to the death benefit year in and year out?
That's probably going to decrease.
It has to decrease. And this is what they call in the industry decreasing term. And again, like the other, it could go like this, but eventually it's going to go to zero. In fact, most policies will zero out at age 65. And here's the problem with that age. 83% of Americans are living past the age of 65. So again, my clients say, well, Jim, that's not a good solution. When I'm going to need it the most, when I'm most likely to die after that age, is when I need the insurance, and here I won't have it anymore. All right? So that's your decreasing term. So again, most folks are not real happy with that. So we say, here's the solution to that. We can get a guaranteed death benefit with a guaranteed premium. But there has to be a third component in order to adhere to these two universal principles, okay? So I'll put on my little timeline here. And Ron, how old are you today?
35.
35, okay? So we're going to sell insurance to Ron at a guaranteed premium with a guaranteed death benefit. The third component is what is called an actuarial reserve. Please do not ask me to say that again. Okay? What the salespeople call that is cash value. But it's actually an actuarial reserve. All right? And how that works is after about the first 3 years, this reserve of money is collected and it grows exponentially over time. and this money is guaranteed. Okay? So here's how that works. This is the insurance company's risk to you the day that you sign that contract based on your age and your health. And then they actuarially figure out when you might die based on mortality. Everybody has their mortality tables. So then they know, hey, we know if we charge him this premium for the rest of his life, we are going to take care of the law of large numbers, and we're going to make a little bit of money and be able to pay out the death benefit. Because here's what happened. As we said, their insurance company's risk is getting greater as you get older, correct? So here's what happens. As that reserve goes along, it's getting higher and higher, okay? Which is in fact then offsetting the risk to the insurance company, okay? Here's an example. Let's say we've got a death benefit of $400,000, and the premium for a 35-year-old is $220 a month, okay? This is guaranteed, and this is guaranteed, as is the cash value as it accumulates. Now let's go out here to age 65. I'm going to estimate the cash value will be worth $120,000, okay? So we understand this. Cameron, if you are 65 and you and Ron come see me, and I wheel up to the table in my wheelchair, and you're 65, you still have $400,000 coverage, same coverage you had back here at age 35, still paying $220 a month, just like you did back here. But you tell me that you've got prostate cancer, and the doc said you got 5 years, okay? So now we know there's potential for death. If we keep the policy and you keep paying the premium, what is going to be the death benefit to your loved one? $400K. If you decide to cancel the money, because you're like, hey, I don't care anymore, I don't need it, blah, 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 and you're 65, if you cancel the policy, what do you walk away with? Nothing. In fact, you walk away with $120,000, which I can guarantee you, if you purchase at age 35, what you get here in your cash value will exceed your total premiums paid. This is not an investment. This is not a savings, but it's what allows them to give you a guaranteed death benefit with a guaranteed premium. Okay? Okay. So you would walk away with $120,000. But if you kept the policy in place, your loved one gets $400K. So here's what I want you to remember. He who has the financial risk owns the cash value. So if the policy is in force, who has the financial risk of your death?
The financial risk?
Policy is alive and well. You're paying your premiums. Who now has the financial risk of your death?
The insurance company.
The insurance company. So they're going to pay out $400. They take this. You see how that's offset their risk now?
Okay.
Okay. Now, if you cancel the policy, who has the financial risk of your death? You do, so you get that.
Okay.
You with me? So can you see then how this cash value allows the company to give you what you want and still adhere to those two universal principles?
Yes, sir.
Okay? Now, let's look at an example here. Again, you come to see me 65, and you have more money than you know what to do with because you've invested for many, many years. Everything has gone according to plan. We've taken advantage of the ups and downs of the market, but everything has come out just fine. And we all agree you are financially independent. Do you still need this insurance?
Yeah.
I would agree, okay?
But no.
But not for income security per se, but another 4-hour discussion we can have over here, which is estate planning, which we will not do today. All right? But yes, in fact, you would probably still need it. Maybe not the same amount. But we don't need it for income security, which is why we would get it back here, correct? Now, let's assume that didn't happen and you ended up somewhere down here. Okay? We are not financially independent. we may or may not be in pretty good shape, okay shape, really bad shape. Do you still need this insurance? Absolutely, because it's now what its intended reasoning is the estate or the income security. We still need a much easier decision. The nice thing is at 65, you're still paying the same dang premium you did back here when you're 35. Make sense? So, here's what I want you to understand. The actuarial reserve grows at a guaranteed rate, okay? And that is what offsets the risk to the insurance company, because they know they're gonna have X amount of dollars offset that increasing risk to them. All right, now, the other thing this cash value does for you, two of which we've talked about, you can keep the insurance, you can cancel the insurance, right? The other three are, you can take out a loan against this insurance. Wouldn't it be nice if you're 65 and your son wanted to start a startup company, he needed $100,000. Cameron, you can borrow $100,000 without filling out a credit report, and it won't even affect your credit. You can borrow it at about 6-7%, give it to your son, no questions asked, and you can pay it back or not. If you borrowed $100,000 and you died a year later and you hadn't paid anything back, they'll just subtract the difference from the death benefit. But it doesn't affect your credit, and you can help out your son. But I will tell you, borrowing from your cash value is a double-edged sword. Most folks do it when it's a last resort, but it does have its positive side, okay? So, the fourth reason is reduced paid up insurance, and I'm going to star that because that's my favorite. And the fifth is extended term. So let's go back to that age 65 scenario where you guys come see me and you've got that prostate cancer. He says you've got 5 years. The extended term will allow you to keep this policy in force at 100% death benefit, and your premium moving forward is 0. So in other words, you could save that premium, still have 100% death benefit, but that's only good for a duration of time.
Okay.
And it may be 7 years, 7 months, and 7 days, for example. So if the doctor said you had 5 years and you died in 5 years, your loved one's going to get $400,000, and you save those premiums all those years. If you live 8 days, so 7 years, 7 months, and 8 days, there is no insurance. So you want to make sure you adhere to the doctor's timeline if it's inside your extended term. But it's a great way to be able to save your premium money and still provide your loved one with 100% death benefit. My favorite is reduced paid up insurance, because we are financial planners. All right, now how that works is you would take a reduced death benefit at some point in time, and we'll use 65 here. So now your death benefit goes from 400 to 320K. Your premium again is 0, but it's 0 for the rest of your life, and there is no duration. So again, in our example, whether you're here or here, if you don't need the full 400,000, you can take a reduced benefit because your home's paid for, almost paid for, the kids are gone, blah, blah, blah. You can offset the income security by some of the investments you do have. So you can take a reduced benefit, still guaranteed to your loved one, but your premium is 0, and that's guaranteed for the rest of your life. So here's the key. This cash value here allows you to keep your policy at a guaranteed premium with a guaranteed death benefit. You can cancel and walk away with whatever is here. Okay? You can take out a loan. Okay? And the sooner you get that policy in place, the greater the value of that loan. You can take extended term, but again, the younger you get that policy in place, the greater the duration that extended term would be. You could go from 7 years and 9 years because you got it at 33. And reduced paid up insurance, this multiplier for how much would be here is greater the younger you get that insurance in place. Is there any benefit, Cameron, to waiting to purchase your insurance when you look at this as a business decision?
Yes.
Is there any benefit to waiting to purchase your insurance from a
wow.
business decision standpoint?
No.
No. There is none. You cannot save money waiting to purchase your insurance. A 32-year-old will pay more. Even though you're paying 3 years earlier, you will collectively pay less in your insurance premiums than one who's 35. And this will be greater, your duration will be bigger, and your cash value will be larger.
Okay.
Subject to your questions.
All right.
Okay, we can turn these off now.
That's it.
Yep.
All right. And that's how you would present the insurance to